Banks and crypto are on a collision course, and stablecoins are right in the middle of it. Lobbying in Washington is intensifying. Trade groups are releasing warnings. Crypto executives are pushing back, and lawmakers are racing to write the rules. Before innovation either locks into the US or heads offshore, at the center of the fight are stablecoins, digital dollars that live on blockchains and settle instantly, 24/7. Banking groups warn they could drain deposits from the traditional system, reducing funds available for loans to households, farmers, and small businesses. Crypto companies respond with a different argument. Many major stablecoins are structured to be backed one-for-one with cash and short-term government debt, rather than lent out in fractional systems. In other words, two visions of safety, two visions of the future. Crypto leaders say they aren't trying to dodge regulation, they're demanding it. Their claim is simple. Clarity brings institutions, compliance, and innovation onshore. What worries them, they say, isn't oversight. It's delay. Behind closed doors, lobbying has accelerated. Bank trade groups have launched campaigns warning about systemic risks. Crypto advocates have mobilized their own policy teams, arguing that new frameworks could actually let smaller banks adopt blockchain rails and compete with financial giants rather than be swallowed by them. Meetings at the White House and on Capitol Hill have reportedly grown tense. Industry lawyers say crypto firms appear open to compromise, while banks remain cautious about moving quickly. Both sides know the stakes. Whoever shapes the legislation shapes the financial rails of the next generation. A major flashpoint has been projections about how much money could move from bank deposits into stablecoins. Supporters of crypto point out that some of these estimates come from consultant-driven models or advisory committees heavily staffed by financial institutions themselves, raising questions about incentives and framing. Meanwhile, lawmakers are balancing three pressures at once: protecting consumers, preventing financial instability, and keeping technological leadership inside the United States. So what happens if Washington can't get this done? Crypto policy insiders warn that prolonged uncertainty could push startups, capital, and innovation offshore, just as decentralized finance keeps accelerating globally. In DeFi, stablecoins are already fueling lending markets, instant payments, tokenized real-world assets, and settlement systems that operate without bank hours or geographic borders. On Ethereum and other smart contract networks, the amount of value locked in these systems continues climbing, alongside tokenized treasuries, real estate experiments, and institutional pilots. Supporters argue this isn't about destroying banks, it's about forcing them to evolve. Just like the internet reshaped media and commerce, blockchain could reshape payments, interest, and financial infrastructure. Banks that adapt could thrive. Banks that resist risk being overtaken. This isn't about FUD. It's about leverage, lawmaking, and who gets to build the next financial system. Banks are lobbying hard. Crypto companies are organizing. Lawmakers are under pressure. And the rules written right now could decide where trillions of dollars and the next generation of innovation end up living. Stop reacting to fear. Start watching the legislation bills, the lobbying dollars, and where developers are actually building. Because this shift is happening whether people are ready or not. If you want real breakdowns instead of recycled talking points, like, subscribe, and turn notifications on for Agent Blockchain. We track the money, we track the power, and we don't let narratives affect our way of thinking.